If you own investment properties, then you're familiar with the dreaded 2 a.m. phone call. The furnace is out, an alarm is going off, the basement is flooding. Owning real estate can be lucrative and a great way to complement your other investments, but it also comes with unique challenges that rarely get easier to manage over time. Today we're going to talk about what to do next when you're tired of maintaining buildings, keeping tenants, and paying insurance premiums. We're going to talk to Andrew Dornfried to help us understand a smarter way to divest from highly appreciated property assets. If turning your rental or office building into a more diversified, liquid, and hassle-free investment sounds pretty good right now, then don't miss this conversation. So Andrew, how do you feel that most people understand, investing in real estate assets? How does that help them? Why do they do it?
Well, it could be primary home if they want to have ownership in their own property, but it also could be rental properties, could be commercial properties rented out to businesses. It's a good way to get tax advantaged income, also get growth, depreciation potential, a lot of reasons to own investment real estate.
You mentioned commercial real estate. Obviously, there are a lot of different areas of commercial real estate. What are some of those different areas? And if you're going to invest in any of those areas, you can choose. You can pick and choose. It's just not a blanket over commercial real estate, right? Because, if we look at, a third of downtown Denver, no one's down there right now, right? They've moved out of those offices, out of that office space. What are the different sectors within the commercial area?
The largest one is still probably office, but there's also industrial, which if you think of Amazon warehouses, just large warehouses, there's a lot of e-commerce growth where those are big. There's also multifamily residential properties, so think large apartment complexes with 200 to 500 residents there with maybe a gym and other things in that sort of property. Those are probably the three main largest commercial. We're starting to see more data centers. Also, student housing would probably be considered commercial as well at major universities. But there's a whole lot of different commercial properties. Those are just some of the largest.
When we're looking at the size of the real estate market, how big is that market? Approximately how many families out there have that as a piece of their portfolio? I see it. When we're talking with families on a daily basis, that there are a good portion of the families that we meet with that have either a second home or a 2, 3, 4, 5 different rental properties. But how big is that market out there?
Well, it's certainly tough to quantify exactly. I think the way I'd frame it is there's about 140 trillion of wealth being transferred over the next 25 years, and about 25% of that is in real estate. So that just goes to show the amount of real estate that's going to be being passed down from that older generation.
That's a tremendous number, 25% of 140 trillion with a T. And, when we look at it, I think a big piece over the years, over the last really 40 years in our marketplace, you've seen lower interest rates overall, right? Plus, a lot of money coming into the economy, which gave people the buying power, especially that baby boom generation, right? Gave them the buying power to buy real estate, and we saw great appreciation in that area. As families are looking at real estate, why is it generally understood as being a good area to allocate some of your money as a good investment?
Yeah, generally you should expect stable appreciation. A lot of people refer to it as an inflation hedge since it's going to appreciate over time, hopefully in line or if not more than the rate of inflation. You're also going to get steady income, and that income is going to be tax advantaged for reasons like depreciation, and there's other tax benefits as well. It also gives you portfolio diversification outside what you might get in just equities and bonds. This is going to be uncorrelated with an asset like that.
And I love finding investments or places to allocate our money that are not tied into the stock market every day, right? And that's where real estate can really come in. And one of those big advantages that we look at is, always the tax advantages. That's a really attractive area. And built into that for, I think that pro real estate investor is understanding cost segregation analysis and how they can accelerate their depreciation on those properties. And that can be an additional item on there for those that understand cost segregation. When we're looking at, the recent returns in the last 5 or 10 years on real estate, they've been really nice overall. Can we expect those moving forward?
Well, it's tough to answer that question.
Probably not.
Probably not.
Right.
But there are certainly some tailwinds in the market right now, and especially from a relative value. We mentioned equities earlier. S&P is up over 80% in the last 3 years.
Yeah.
Real estate, industrial specifically, up about 12.8% over the last 5 annualized. So it's still a nice return, but on a relative basis, it looks like equities and things like that might be a little bit overvalued depending on who you're talking to. Real estate seems like a better entry point.
Yeah, could absolutely be. So what makes real estate more challenging to own over other asset classes? So like if I go buy an ETF or stocks and so forth, I can hop online, check my account balances. Maybe I change those out every once in a while, but what I see is the maintenance on that. Or if our portfolio managers here for our clients, our CIO, he's taking care of everything. He's the pilot. He's managing everything on that end. So it's pretty low maintenance for our clients to be able to do everything. But when we're looking at real estate, what's challenging then in that area to manage those properties?
Yeah, so a colleague of mine once said to me a long time ago, it's the 3 T's, the toilets, tenants, and the trash. So it's the toilets, right? It's the maintenance. Are things breaking? You're responsible for fixing all of that. There's also the tenants. You have to make sure that it's always full. If it's not actually occupied, then you're not getting any income. There's going to be the insurance on the property. You're also paying property taxes. And, there could be things happen like the financial crisis where you lose almost total value of that property.
You look at all that. One of the biggest complaints I hear from families all the time is they'll say, Kyle, we bought these properties, 3 properties, 5 properties, whatever, years ago. It's been great for us. We've had appreciation. We've had a nice income off of it. That's helped us to pay the properties down. But I am tired of the 2 a.m. phone call. I just don't want it anymore. The tenant piece, right? And that's because the toilet is clogged, right? Whatever it may be. And so replacing roofs and water damage, insurance, property taxes have gone way up on properties the last several years. So there are a lot of challenges to all that. And what I find is a lot of the families out there that we deal with every day, they're tired of dealing with those different areas and they want to offload that. But I found that the biggest hindrance to them doing it is they don't want to pay the tax now on the appreciation from the property and the depreciation that they've received over the years. There's a big gap in there and they would owe a significant tax on that property. So, overall, it sounds like a lot of it is really challenging. There's the physical exhaustion, it's time intensive. There are things that are just not in our control. So Andrew, we know divesting from real estate can be challenging. What are some of those challenges if someone says, okay, I want to do something different with my money here? What are the challenges that they face?
Main one is going to be the capital gains tax rate. When you sell that, you're going to get taxed, depending on what state, could be upwards of 20 to 30+%. You're also going to have that loss of income. So you'd have to replace that income with another product where you probably won't be getting the same sort of tax advantages. There's also the family dynamics. So in real estate, when you pass down a property to a beneficiary, typically you get a step up in basis. That might not be the same for every type of asset. So there's a whole bunch of reasons why it might be tough to let go.
Yeah, and I see the kids all the time where they just inherited, whether it's multiple properties or maybe it's one large property. And so let's say there's 3 or 4 kids and they inherit, a group of properties or one large one. And 1 or 2 of the kids say, you know what? I want the cash. I want to sell these properties. Whereas the rest of the kids are saying, no, we want to hold them because, there's an emotional tie to it. This was mom and dad's property, right? Or there's income coming off of it and they don't necessarily need that lump sum. But some of the kids are saying, hey, I do want that lump sum. It would help me financially. I want that money. That's where I think, where we can take families down a path to maybe solve some of the issues. And one of those is to look at a 1031 exchange. And as we go down this path, I think there's some liquidity pieces here that we can bring to the table to help those families out where they still get the income, they still have some benefits in here. So let's talk about a 1031 exchange. What are they? How do they work? Maybe walk us through that a little bit.
Yeah, so a 1031 exchange is part of Section 1031 of the U.S. Internal Revenue Code. Essentially, it was designed to encourage reinvestment in properties by allowing investors to invest their proceeds into a like-kind property and therefore defer capital gains. So it was designed to essentially eliminate that problem that you just mentioned, that capital gains tax when you do sell. This is designed where if you reinvest all of the proceeds into a like-kind property, then you get to defer those taxes.
So let's walk through how does it work. So let's say a family has 5 properties and they say, you know what, I'm tired of dealing with the 3 T's. I'm over it. Okay. And I want to do a 1031 exchange. Now, a lot of families think, well, if I do a 1031 exchange, I'm going from like property to like property. All I'm doing is just exchanging these 5 properties for another couple of properties. I haven't fixed the issue. I'm still dealing with the 3 T's. Let's first of all talk about just how a 1031 exchange works, and then let's talk about how to fix that issue so they're not continuing to work with, have that problem with the 3 T's. So how does a 1031 exchange work?
So the most basic step would be engaging a qualified intermediary. So that's a firm you have to talk to before the sale. Essentially would act as like an escrow account to make it eligible for a 1031 exchange. Then you'd sell your property. Those proceeds would go directly to that 1031 exchange. After that, there's a few timelines. You have 45 days to identify a property to potentially move into. Then you have an additional 135 days for a total of 180 to actually close on that new property.
Got it. So we have to use that intermediary in there. That's a key component. You as the owner, when you sell those properties, you can't touch that money. The money needs to go to that intermediary. So one path that, I think which has been the traditional path is someone sells their properties and they roll it into a 1031 exchange and they use the 1031 exchange path and they roll all those assets, the cash assets, into new properties. But all you did is you just exchanged 5 properties for another 5 properties, and you still have the same problems. You're still dealing with the 3 T's and so forth. So what are some options out there that most people probably aren't aware of to do a 1031 exchange, but now eliminate all those headaches from the tenants and those phone calls at night?
Yeah, so one of the most well-known ones or popular ones would be what is called Delaware Statutory Trust, or DST for short. Essentially what that is a collection of professionally managed properties where the client could put the proceeds into a DST and receive fractional ownership of that DST. And those properties are not managed by them. It's managed by whatever company it owns all of them and is managing all of those properties. So professional manager, I guess, is a better way to put it.
So why would someone want to do that? What are the benefits of doing that?
So first one is to solve your problem. No longer have to deal with the 3 T's. You don't have to worry about what's going on with the tenants, the trash, the property maintenance, things like that. You're also going to get further diversification. Typically, those DSTs are going to be larger and maybe be 5, 10 plus properties. Could be a couple $100 million in value. So certainly if you're selling a property for $1 million and now getting a fractional ownership of something that's worth 10 properties for $500 million, a lot more diversification, and you're going to get income off of it as well. You can also choose what properties it's going to be. It could be industrial assets, it could be multifamily assets. It doesn't have to be the same type of property that you sold.
Right. So it's going to give them greater diversification. It's going to spread out some of that risk. What about the yield, the return on that? Can they, what I've found is that in a great situation for most families, if they're getting about I find that most families kind of get that 4 to 6% yield off of a property, meaning if it's worth $1 million, all their properties, that they're generally getting $40,000 to $60,000 a year of rental income off of those. Can we expect something usually around that same number?
Well, that really go back to what type of properties they were. If it was an office property, maybe that's a bit higher yielding. Industrial asset, probably lower yielding. Retail, somewhere in the middle. Multifamily, somewhere in the middle. But I think generally 4 to 6% sounds about right. The thing is sometimes when you're managing your own property, you have the sweat equity, you have the elbow grease, and sometimes you can earn a bit of a higher yield that way, but you're putting a lot more work into it and having to manage it yourself.
In that situation, so let's say they sell all those properties, do they have to roll everything into this new DST, or can they take some of that money off the table?
Good question.
If they want some cash.
They can take some of it off. Yeah, so how it works is if you want to completely defer taxes, then you have to exchange all of the proceeds. Mm-hmm. You could leave some out. You would just be responsible for taxes on those proceeds since the gain would come out first. But you absolutely can keep some out.
So let's say they do that. And tell us about another section of the IRS tax code that they might be able to take advantage of, which is line 721 of the tax code. Tell us about that and how that works and how that's tied into the DST.
Yeah, so Section 21 allows investors to contribute appreciated real estate into a partnership. Typically, we see that being into a partnership of a REIT, a real estate investment trust, and they're receiving operating partnership units in that REIT, commonly referred to as OP units. This also doesn't trigger any capital gains. So essentially, how we see these working in conjunction is going into a DST via the 1031 exchange part of the tax code, being in that DST for a period of time, and then contributing that to a REIT where you now receive operating partnership units, which are fractional and divisible over time.
Just to keep it simple, similar to shares, if you will. And then a family, if they're looking at that, they can choose to sell some of those shares later down the road once it's in that UPREIT, right? And they can also choose shares that are cost basis, right, and shares that are actually appreciation, which would be taxable. So if they rolled that eventually into that UPREIT, a lot of families can sit back and choose, okay, I want to pull my cost basis back out, which is not taxable. Now I'm pulling that cash directly back out, and I'm leaving that taxable portion in there, right? So that can be a nice advantage to continue to postpone or defer that tax.
Yeah, I would say the two most popular ways I see this being used is the one that you're mentioning, is where you do have fractional shares, or I guess divisible shares that you can sell over time. So spacing out the tax years, things like that, or using it as an estate planning tool.
To take that further, if we're really digging into tax planning there, let's say someone has, just to use a round number, $1 million capital gain that they've now postponed into this UPREIT. And rather than selling that entire $1 million capital gain, which is going to push them into the highest tax bracket and getting hit with all of it, they could start selling a portion of that off year after year after year in lower tax brackets, therefore giving the IRS less money and keeping more for that family.
Absolutely.
Right. Who wouldn't want to do that?
Yeah.
Right. And when we go back to the family dynamic piece, let's say we have, several kids that inherit properties. They don't want to, have that taxable gain. Maybe they inherited it from mom and dad. They hung on to those properties originally for a while, and now they've decided to roll this into, even though they got cost, step up in basis, maybe those properties continue to appreciate. Now they want to sell a portion of it, right? One or two of the kids want some of that money. They could go through this DST, go through, use the 721 portion of the tax code, and one or two of the kids could start selling off some of those portions, right, to get their liquidity, whereas the other kids are going to continue to postpone that and just get the yield and keep that diversified piece of their portfolio there. So let's walk through, an example here. So let's say mom and dad have 5 properties. Walk me through this and how the kids eventually inherit it, but maybe a couple of the kids want to sell off a portion of what they've inherited without the other kids, having a taxable event.
Sure. So that would depend on how many properties they're selling, but let's just say for one of those 5 properties, let's say it's worth $1 million and they're selling it. So they'd sell that, it would go to a qualified intermediary, they'd go into the DST, they'd be in there for a period of time, say maybe 2 to 3 years, getting an income along the way. Then they'd utilize the 721 part of the tax code, move into the REIT, get the operating partnership units, and start to get yield of whatever the REIT is paying at that time. So let's just say 5 years down the road, that person dies and that $1 million has grown to 2. Now we're $2 million. Each beneficiary, if there's 2 children, would receive $1 million worth of these operating partnership units at a step up in basis. And then what can they do? They can go ahead and sell all of those for no tax because of the step up. They can sell some of them and keep some of them in, or they can decide, well, I don't really need the money right now and I like the income. I'm going to keep all of them in the REIT. So they have a lot of optionality.
That sounds like an amazing situation. I mean, it gives that family a lot of flexibility, choice, and control that they just don't have today. When you're sitting on all that real estate, you're answering those phone calls, you're taking care of tenants and so forth. Now you've handed some of that risk and responsibility off to someone else, and you can sell the proportionate shares down the road, whatever you want to do. So that control piece, I think, is a big one that's really attractive that we're seeing for a lot of families out there.
Absolutely, yeah. And then let's say that one of the beneficiaries really likes to manage real estate. That $1 million, it's at a step up in cost basis. They can go ahead and sell that and go buy real estate that they want to manage themselves. The other beneficiary, maybe they don't like managing real estate, but they still want the exposure to the asset class for all the reasons that we mentioned earlier. They can stay in there in that REIT with those shares, get income over time, hopefully appreciation as well, take partial liquidity, take full liquidity. So just a ton of optionality, like I mentioned earlier.
Yeah, I love the choice and control. I think that's really attractive to a lot of people.
Yeah, so one of the benefits is you have these divisible operating partnership units now, which you can sell over time. So let's say you need $50,000 in a particular deal, you can sell $50,000 worth of these operating partnership units. You might be responsible for the capital gain on that, but there's things you can do where maybe you have losses elsewhere in your portfolio, work with your CPA, offset those. There's a whole lot of things that you can do.
Right. So tax loss harvesting, right? Yeah. So if there is a portion of that portfolio that's down, so now we have capital gains losses, we can offset the gains over here that we want to sell and wash out some or maybe all those gains overall. And I think a strategy when you really, I think, take things to a high level here. So one of the strategies that I've seen families implement is where they roll that over into the UPREIT using that the 721, and they pull out that cost basis. And let's say that that's $100,000. Now they take that $100,000 and will invest that and create a portfolio there, and use basically tax loss harvesting on a daily basis against what's still in that UPREIT over here, where we only have capital gains and everything's taxable. And what we'll do is we'll take that portfolio, and anytime there are losses, we'll sell off some of those losses and offset, also sell some of the gains over here in this portfolio, and slowly siphon some of that money out over time, and do that in a way that's not taxable to that family. And it just creates a great situation overall where we're getting more liquidity, we've got that diversification, and we're working to really use the tax code to our advantage versus just getting nailed with taxes and selling everything, which is unfortunately the path that a lot of people take just because they don't understand the 721 piece of the tax code.
Absolutely. That's an awesome strategy.
So Andrew, given all the advantages of this path for families, why don't more people take advantage of going, using the 721 piece of the tax code?
The simple answer is awareness. I don't think a lot of people know that this is out there. A lot of people are familiar with the 1031 exchange, but having to go into a property that you'd continue to manage. I don't think a lot of people know that you can go into this DST and eventually go into a REIT where you have these partnership units. I would also say just the proliferation of these non-traded private REITs as well. It wouldn't work the same way for a public REIT, but with more of these non-traded REITs in the wealth channel, we've started to see this grow in popularity. Still certainly an awareness problem, though.
I agree. I mean, I talk to real estate professionals all the time, or people that have multiple rental properties, and they're just not aware of cost segregation analysis. They're not aware of applying tax loss harvesting and direct indexing to a portfolio along with your real estate, and using this portion of the 721 piece of the tax code to chip away at all that. It's just the CPAs, they're great historians. They look at what happened last year and they're going to fill out your tax return. Most advisors, they love to do annual reviews where, again, they're looking backwards versus doing the tax strategy, thinking forward, how can we continue to improve where we're at, be more efficient, get more out of our dollar every day, and do that true planning. I see that missing in the tax industry, the financial industry. It's a big piece out there that unfortunately families end up paying the price because they pay more in taxes because of the lack of true planning and expertise that's out there.
Yeah, absolutely. It just goes to show the importance of having a good CPA tax planner. There's a whole lot of things that you can do that most are not aware of. Adding on to the lack of awareness is the fact that you have to be accredited to do this sort of thing. So you don't see public marketing of this. So you're going to have to go through a financial advisor. You're going to have to go through someone like EdRock to even access a product like this.
Right. And that limits, unfortunately, a lot of families out there. But, the families that do have properties, maybe we could go through that a little bit. What are the properties that would be eligible for this type of exchange?
So it's really broad. It has to be, investment property is considered held for investment. So it's probably easier to even go through things that wouldn't apply, right? But things that will apply: single family rental, commercial real estate, could be raw land, water rights, mineral rights. So a whole lot of things that qualify. Really, the things that don't are going to be primary residence. That's not going to qualify. A second home that's not rented out, but if it is rented out for a certain amount of time, there's regulations for that where it could be considered. So I think it's important to just know it's a very broad definition of what would be considered investment property.
Andrew, thanks again for your time today. I always learn a lot digging into the real estate area. So for families that want to learn more about DST and line 721 of the tax code, throw in your questions below or reach out to us, and we'll make sure we get those questions answered. And like and subscribe for any future podcasts that we're going to have, because we'll continue to throw out, I think, great information when it comes to alternative investments and tax pieces for your portfolio, so you can allocate the right way and get the most out of that portfolio for the long run. So thanks again for your time, Andrew.
Thanks again for having me. I appreciate it.